Hi, everybody. My name is Robert Embree. I'm the Vice President and Senior Economist here at Rosenberg Research.
Hi, and this is Mehmet Beceren. I'm the Senior Market Strategist at Rosenberg Research.
And we wanted to have a little chat today on some of our updated China views. Last 2 weeks, we've written 2 new pieces, one about the changing macro environment in China, and one on some different asset classes in China, looking at the ways investors can play different sectors and some selected corporate bond indices. So in our 2025 outlook 6 months ago, we were pretty bearish on China. We correctly identified that Donald Trump would be bringing in major new tariff barriers and that China continued to have a massive ongoing property crisis. And that's been a big problem for their macro outlook, not just in the last 6 months, but for several years. What's new in the last 6 months is the interesting ability of policymakers in China to navigate these twin crises. So in the first part of our report on the macro outlook, we show that a lot of the indicators of real estate, the real estate climate and new construction, haven't rebounded, but they seem to be bottoming out. And while there have been some major bankruptcies of property developers, it looks like a lot of that problem is, if not solved, then at least contained. And the other interesting thing that's been happening is the remarkable success that China's had in rerouting their exports away from the United States and towards other countries. So exports to the US obviously now face this massive 55% tariff, which has changed several times in the last 3 months. And Chinese exports to the US are down double digits, but Chinese exports to the rest of the world are up, and the net effect is roughly flat. And so that's a remarkable accomplishment, and it has real implications for investors. So why don't you talk a little more about some of the more specific asset class implications of that?
Yes, Robert, as you say, there are definitely some very good signs of stability and improvement in the overall macro-financial conditions in China. The real estate market's correction, the local government finance vehicles issues, and the related credit crunch has been weighing on the market sentiment for a long time. But that seems to be stabilizing and improving. So the bond markets and the stock markets are showing the improvement on that sentiment as of late. And in our market strategy report, we looked at different segments of the market that might look more attractive to the investors that are looking to increase their exposure to China at this time. And we particularly looked at the profitability trends in different sectors and looked at the different segments of the fixed income market and identified some interesting tactical opportunities in the market.
What's one example of a sector I think that would be?
For example, healthcare, which has been under the radar for a long time, and it has been showing very weak profit growth, is showing some remarkable comeback in terms of profitability. And it is not occupying the flashy headlines like the tech sectors and the EV sectors that is associated with China. So we think that this sector is going to outperform the rest of the industries, such as autos, for example, which is suffering from a chronic overcapacity situation. So tactically, it looks pretty attractive. And from a strategic point of view, also the growing healthcare market globally and the demographic situation in China is pretty supportive of this sector, which is coming out of a very weak period of profit growth. So we like that. And the financials also look pretty interesting. They, again, don't occupy the headlines and the flashy thematic overhyped indices, but they seem to be benefiting from the deregulation cycle in China. For example, the southbound Bond Connect that is ongoing this summer is going to open up new markets for these financial companies. So we think that is the potential profit growth is looking pretty strong for these for this sector. We advise against these overhyped EV, AI type of technology stories, which is being oversold to the investors, and they don't show any good profitability picture to us.
The EV thing is really interesting because if you just looked at the top level data, the macro data, Chinese EV exports to the rest of the world are booming. But what you've been finding is that even if revenue's up, it doesn't translate to profitability.
And that's one of the key messages in our report. There is a very wide disconnect between the return on equity, return on invested capital versus the top line growth. The Chinese growth policy is always driven by overcapacity and global trade. So if you just follow those top line growth stories, the flashy headlines about tech, you tend to lose in terms of the return on equity. But if you focus on quality and profitability trends and sustainable productivity growth in different segments of the economy, I think there are opportunities. So one of the key messages in the report is that don't get into lazy, generic, broad indices. Look more granular. There are some very bright spots in terms of profit growth, for example, and try to stay away from this overhyped top-line growth stories, which is not coming with profits at the same time.
Right. I think that's really important. We have been talking a lot about international diversification away from the United States, but it doesn't necessarily mean just buying everything internationally, right? Particularly with an economy like China that varies so much at the sector level, you really want to be selective. And so you should take a look at these reports. That's the kind of insights we provide here at Rosenberg Research in terms of getting more specific beyond just buy this country, sell that country. To manage risks, it's really important. So let me just ask you one last question, which is, big picture, I mean, China has so many of these intangible risks. There's a lot of geopolitical risk, there's policy risk. How investable is China?
That's a big question. Of course, what we are discussing here is all based on the assumption that these geopolitical risks and the trade tensions will be relatively under control. If this spins out of control, of course, we live in a different world. So, but leaving those risks aside, which looks like they're going to be with us for a long time. The financial deregulation, for example, is a major story in China, and I think they're becoming more and more investable in terms of being available to foreign investors. So in this geopolitical environment, actually the Chinese authorities are trying to attract foreign capital and trying to be more of the center of the global trade and the reserve currency. In that sense, yes, there are geopolitical risks, but the policy initiatives by China is supportive of investability going forward. So there are two counteracting factors here.
Absolutely. Thanks again for a great chat. And if you're interested in these reports, please reach out to our sales team. And thanks for watching.